something you may have already seen speak about in the documents we get. You might have seen people talk about it online on like Bloomberg Live TV or whichever sort of news outlet you like to use. So different type of bond curves. This is something that is very, very prevalent, especially during this stage of sort of the cycle. And we're going to go over just the 4 different types of yield curves that a lot of us may not already know, or may already know, but you don't really know how to apply that into FX. So first, there are 4 main type of yield curves within the bond market space that as traders you have to understand. So there's a bull steepener, a bull flattener, a bear steepener, and a bear flattener. A lot of, we are obviously in 2023 at the moment, and a lot of people are expecting this bull steepener to occur. And we're going to go over essentially what that means in the next couple of slides. So let's move straight over to a bull steepener. And a bull steepener is simply when the spread between the long-term rates begin to widen against the short-term rates. This is known as a steepening yield curve. The word bull represents bond prices climbing higher. It doesn't represent the yield, it represents the bond. So if you want to know if it's a bull steepener and you only look at yield, just think opposite. So when you hear bull steepener or bull flattener, just think, okay, well, that means the yield curve is likely falling. And vice versa, a bear flattener is obviously, or a bear represents, the yield actually climbing higher, so it's the opposite. And obviously when they refer to the bulls or the bears in the bond market, they're referring to the actual bond prices, not the actual yield. Unless somebody specifies that they're talking about the yields, they'll put obviously yields at the end of when they're speaking. It can either be positive or negative for the currency, dependent on the type of expectation that is occurring. So this is very, very important, because obviously we understand that use bonds and other aspects of or other asset classes as a way just to help confirm sort of your bias in an FX trade. So we typically see this curve occur when interest rate expectations are falling or a flock to safety is occurring, where bonds are being bought as a safe haven. We tend to see this happen when a recession is expected. So of course, during the March, April sort of time period, we did see a lot of bull steepening, because obviously during March 2023, a lot of us knew about how the massive bank crisis. People are scared, right? And what do? They buy the safe haven. They buy bonds as a proxy to that, because as we know, as we've learned in previous videos, the 2-year yields are a lot less sensitive, shall we say, to that longer term monetary policy stance. Because if you buy a 10-year, it's a lot more prone to swings in currency, swings in monetary policy, swings in inflation and interest rates. So they tend to just cap, or they buy the lowest sort of maturity that they deem fit, and that just creates that bull steepener. So buying the bonds or the 2 years yields, shall we say, falls faster than that 10-year yield, and that's what a bull steepener is. Remember to look at what else is happening for the currency if we are seeing a bull steepener. So why are we seeing a bull steepener? That's the question you have to ask yourself. And throughout this presentation, I'm always going to tell back to what is the data doing? What is the data doing? So it's about understanding, why is a bull steepener occurring? Why is a bull flattener occurring? What is the actual underlying reason for that? Is that bullish for the currency, or is it bearish for the currency? So that's obviously something to very know. And we'll look at an example now. So a bull steepener example. So as you can see, those 2-year yields in this example here has fallen faster than that 10-year yield, which is in the orange line there. So as you can see, just the velocity in which it's fallen is a lot quicker in that time period than when than that 10-year in exactly the same period. So that's exactly what a bull steepener would be. And remember, that could either be bullish the currency or bearish the currency, depending on the sort of time, or what's the reason for it, essentially. If it's creating a bull steepener because of interest rate expectations are falling, then that obviously is generally negative for the currency, and think, okay, that gives me a holistic view of that maybe you want to be selling that currency. Now, let me look at the data to see if this will confirm, or let me look at the sentiment as well to see if that is going to be the case. So a bull flattener is simply when the long-term rates are falling faster than the short-term rates, and a flat yield curve occurs when the short-term rates is close to the long-term rates. We would expect a bull flattening to occur when investors expect a contraction / a slowdown in the economy. We would expect the currency to show some weakness, but to remember to look at other variables to a currency direction. So remember, if you're seeing a bull flattener or a bull steepener, both are generally in somewhat negative for the currency, dependent on the actual reasoning why we're seeing that specific type of yield curve. That's something to note, please. So let's look at an example of a bull flattener. So as you can see, orange line is that US 10-year, the blue line is that US 2-year. As you can see, that 10-year has fallen faster in terms of the yield than that 2-year. And you have to note here that they don't have to both be falling. The yields don't both have to be falling. They don't both have to be rising in any example. It's just during this time period that we're seeing, or if you're looking at it from a historical stance, or if you're looking at it from the today stance, look at the day. So look at the day of the yield curve, or look at the week. How far has that 10-year fallen in that week or that month period that you're looking at? How far is it falling in that week period, the 2 years? And think, okay, well, the 2-year, in this example, let's look at it from a bull flattener example. In this month or over the last couple of months, we've seen a bull flatten because we've seen the 10-year yield, for example, random sort of figure, we've seen it falling by 10%, whereas the 2-year yield, we've actually seen it, fall by only 2%. So that's obviously a bull flattener because obviously the 10-year yield has fallen faster than that 2-year yield. Again, remember, they don't have to necessarily both be falling, the yields. It's just to note that that 10-year yield is actually falling faster. So now let's move on to what a bear steepener is. So this is simply when the long-term rates are rising faster, or the long-term rates rise faster than the short-term. A bear, as I said in sort of bull example, a bear represents the bond prices falling, please. They don't mean, when you say bear, or if you hear institutions say they're bearish on the 2 years, they mean that they're expecting likely that 10-year or that 2-year yield to be climbing. Of course, unless they specify they're bearish on the 2-year yield, for example. But if they say they're bearish the 2-year or they're bullish the 10-year, they're expecting, of course, if you're bearish the bonds, you're expecting yields to climb, and vice versa. If you're bullish bonds, you expect the actual yield to fall. A bear steepener typically occurs when the markets are expecting inflationary prospects to grow in the economy. So that in itself would actually be relatively bullish to the currency. So as you can see here, this reflects through to a stronger currency. As always, remember to look at the other factors of the market too. That's very, very important. And that's what a lot of traders get stuck on, and a lot of traders trip up on, is that they don't look at the reasons why we're seeing a bear steepener or a bull steepener or a bear flattener. We have to understand the underlying reasons for that. And if you think, okay, well, we've seen a lot of great data in the US or the UK, for example, we're seeing a bit of bear steepener. Well, that would indicate likely we are seeing some inflationary pressures. That in itself gives the market an indication that maybe the central bank might need to raise rates soon. And that in itself, markets would likely buy up the currency in that sort of environment. However, if you're seeing, this bear steepener occur, inflationary pressures rise, but the actual economy is contracting, that wouldn't be very positive for the currency. That would actually be seen as negative. So because it would just create that stagflation sort of environment. So it's always important just to tell back to what is the underlying reason. So let's look at a bear steepener example. So as you can see, that 10-year yield is rising a lot faster than that 2-year yield in the blue there. So that in itself entails, likely an inflationary sort of environment in the economy itself, which generally comes from an expanding economy. If an economy is really, really, driving forward and driving up, that just creates inflation in on itself. So that, you could pale back to a currency view with, in the back of your mind, that's relatively positive for the currency. Let's look at the reasons why this is occurring, and that will just give you a sort of an overview of what your sort of bias might be for the currency during that time period. A bear flattener is simply when the short-term rates are climbing faster than those long-term rates. This typically comes when we see investors expect the Fed to raise rates or raise interest rates in this example here. This is positive for the currency, as a hawkish central bank tends to benefit the currency given the data in the economy supports it. So like we've seen before, there could be a massive bear flattener, so that 2-year yield is actually climbing a lot quicker and actually flattening the curve, i.e. closing the gap between the 10-year. I'll show an example in a moment. But then let's say the data is really, really poor in the economy. Again, that sort of scenario there, you would likely, or you wouldn't really see a sort of strength in the currency during that time period. We saw that as a perfect example during, the 2021 within the UK. At the end of 2021, we saw all of this happening, but the currency or the actual data was terrible. And as a result, the currency actually sold off. So it's important just to understand as to the currency and the data. Bear flattens, as you can see, that 2-year yield is climbed a lot faster, flattening that yield curve. So you notice how during that October period on the left there, how it's quite wide. And then we get all the way towards that March 22, and it's actually closed the gap a lot. And that's what I mean by that bear flattening example. So that would be actually pretty positive for the currency, given the underlying data is relatively, good. And we saw here, as we know, if you look back into the DXY or whatever sort of dollar sort of index you like to look at around June 2021, and then we saw a really big pickup in the currency. And that's coupled with inflationary pressures rising, and that's interest rate expectations are also expected to rise as well along with that, and that's also generally positive for the currency. But the main thing for that's the sort of underlying reason why we saw this happening, is because yes, one, inflation or inflationary pressures rising. 2, the market is in the understanding that interest rates are going to be risen soon, and 3, the most important thing is the data supported it. And this is why we saw that massive, drive up in the DXY. You could obviously look at Euro examples as well, look UK examples and see, okay, well, we saw a bit of bear flattening. Okay, that in itself sees a bit of, that would give me an underlying reason as to maybe I want to be buying the currency. Are we starting to see, is the data supporting it, for example? So go back and do that for the Euro, go back and do that for the UK or whichever currency you want to do it for, and just see, okay, well, during this time period, go back before COVID, because a lot of us knew what the currencies were doing during that period, because a lot of us has maybe just about started trading during this during COVID, or maybe a year before COVID. Go back to like 2011, 2010. Go back to 2013, 2014, when a lot of us were unlikely trading during that time period, and see, okay, well, we're seeing bear flattening or we're seeing a bull steepener here. Okay, let's look at the data. Let's look at the sentiment during that stage, because this is when you really, really grow your knowledge base. And this is a very, very good tool for your toolbox, really, because this will separate you from the average trader to a great trader, right? And when you start talking to people in trading and you're saying, yeah, we're seeing a bit of bull steepening at the moment, they're going to have no idea what you're talking about. And then you really show you know what you're talking about here. But hopefully this explained it in a little bit more detail. So that is the different type of bonds. I will see you in the next video. Take care.